Feel free to jump in, raise your hand if you have questions while I'm going along. Most people are like, wait till the end, but I'm cool with you wanting to ask questions as I'm going along. So if you want to do that, I'll answer them as I'm going. So real quick, if you could read that, we don't give advice, is basically what this is saying. So before you make any investment decisions, talk to an advisor or CPA or somebody like that. But what we do with self-directed IRAs, we don't sell investments, we don't recommend any particular investments, we don't give any advice. This is what we're going to talk about, go over a little bit about my company and then self-directed IRAs, and then specifically we're going to talk about investing in real estate inside an IRA, and then just different things that you need to know. That's me. So a little bit about Entrust. We've been in business for since 1981. So you've been allowed to invest in non-traditional investments inside an IRA ever since ERISA went into effect in the mid-1970s. But most people don't know that. Most people don't know that you can invest in things like real estate inside an IRA because banks and brokerage firms are not going to be holding those types of assets. So people think that the only thing you can invest in are stocks, bonds, and mutual funds, but that's not true. So that's just some information about our company, a little bit more about the company. So what is a self-directed IRA? First of all, a self-directed IRA is not a type of IRA. It's a description of the service that we provide. So types of IRAs are traditional IRA, Roth IRA, SEP IRA, simple IRA, then there's 401ks. So those are the types of retirement accounts. So people who open an account with us, they still have to tell us what type of account they want to establish, whether it's a traditional IRA or a Roth IRA or whatever. But because we're a self-directed custodian, by definition, that account with us is a self-directed IRA. So what is the self-directed IRA? The individual account holder makes all their own investment decisions. So we as custodian don't get involved in helping our account holders decide what to invest in or doing any due diligence on their investment. That's entirely the responsibility of all of our account holders. And two, the other part that makes it self-directed is you can invest in non-traditional investments. Non-traditional investment is anything other than a stock, bond, or mutual fund. So if you want to invest in a mutual fund, you want to invest in a publicly traded stock, you can have your account with a brokerage firm. Not only will they, hold those investments, but they will also do research and give you advice and tell you whether they think that's a good investment or not, right? So those are the conventional retirement accounts. Self-directed, we don't give the advice, but we'll hold non-traditional investments. So in order for a retirement account to qualify as a retirement account, it must be held by a third-party custodian, a financial services company that acts as custodian. So that's our role. We have our own trust company, so we are a financial services company the same way that, again, Merrill Lynch, Charles Schwab, Fidelity, all those companies are, right? So same reporting done to the IRS, same reports get sent to you at 1099 when you take a distribution, 5498s. We do all the same record-keeping things that you would get from a brokerage service. The difference, again, is in the types of assets that you can invest in. So what are the benefits of doing self-direction? You get more control over your investments. If you're into real estate, it opens up the opportunity for you to invest in real estate. If you're into digital currencies, you can invest in digital currencies. If you want to be a private money lender, you can use your IRA to do that. If you have a friend who's got a restaurant and they're looking for funding, you can invest in your friend's restaurant. Like, you can do almost anything you want inside your retirement account. We had somebody invest in cattle, in a bowling alley, in an airplane, in a racehorse. You can invest in a lot of different things inside your IRA. So it's true diversification. When you have a retirement account with Merrill Lynch or Charles Schwab and they tell you, buy this stock and this fund and these three funds and look how well diversified you are, except all those investments are in the market, right? So the market tends to go up, market tends to go down. All of your funds are going up and going down, maybe not the same percentages, but they tend to move in the same direction. Whereas if you have a self-directed where you might have real estate or you might invest in tax lien or like any of these things that are not tied to the market, they could go metals, tend to go in the opposite direction of the stock market. So if you held gold or silver inside your self-directed IRA, it's not necessarily going to move in the same direction. So it's true diversification. And then you get the tax benefits. If your IRA owns a rental property, if you own a rental property and you're getting that rental income, then at the end of the year you have to report that, right? And then you write off expenses, and then potentially you have to pay extra, or you get to deduct the loss. But when an IRA owns a property, it's the IRA that owns the property, so the IRA receives the income. So there's no tax consequences to any income that's generated from it. If you want to sell the property, there's no need to do a 1031 because it's the IRA that owns the property, right? So you buy a property for 100, you sell it for 200 inside your IRA, you just grew your property, or you grew your IRA by $100,000. So what is a real estate IRA? It's more of a marketing term. It simply means that your IRA is invested in real estate. So again, real estate IRA, like self-directed IRA, is not a type of account. It's more of a marketing term. It just means that your IRA is invested in real estate. So the IRA options are traditional IRA, Roth IRA, and then if you're self-employed or have a business, you can have a SEP, a simple, or an individual 401k. And as it says on there, any kind of real estate is eligible. You can invest in any kind of real estate. You can do single family, multifamily, you can do land, you can do offshore, you can do all of these things inside an IRA, right? You just can't buy a property that you're planning on living in, and we'll get to that. So this is a screen. I do this presentation for realtors a lot of times, so this is sort of focused towards realtors and how they can benefit from doing this. So I'm going to skip past that. So again, investment options. What can you invest in inside an IRA? I'm going to go straight down to the very bottom bullet. Almost anything. You can invest in almost anything you want inside an IRA. What can't you invest in? That's actually made up of three things: collectibles, life insurance, and S corporations. So you can invest in any corporate structure you want. You can invest in LLCs and limited partnerships, C corps obviously, but you can't invest in an S corporation. Collectibles would be, like it says on there, work of art, rug or antique. Metals or gems, now that's coin collection metals, as opposed to precious metals like silver and gold of a certain fineness or purity. So there are dealers out there that will sell you metals that are investment grade that you can do an IRA, and there are dealers that will sell you that are collectibles. So you want to know the difference. You can't do a collectible. You can do metals that are of the right purity: gold, silver. Typically gold, silver, platinum, and palladium are the metals that you can invest in inside an IRA. You notice it says there, any alcoholic beverage. So you can't buy like wine, right? Like a really expensive wine, you can't buy that in your IRA. But your IRA could invest in a winery, right? Your IRA can't own art, but your IRA could invest in an art gallery, right? One's a business that your IRA is allowed to invest in, the other was considered a collectible. And then life insurance. You can't own life insurance inside your IRA. So other than that, other than those things, your IRA can invest in anything. So these cars you would think they'd be a collectible, but actually cars have a unique standing with the IRS that you can actually buy a car as an investment inside your IRA. But you can't ever use the car. You can't ever drive it. You can't even sit in it, right, as the account holder. But I just, since we have all these cars around us, I thought I'd mention that one. So there are rules around what's considered a disqualified person associated with an IRA. Essentially, it says that the IRA can't do business with a disqualified person. So that's the account holder's spouse, the account holder's ancestors, so parents, grandparents, etc., lineal descendants, so children, grandchildren, etc., and then spouses of lineal descendants. And then that last bullet point, anyone with 50% ownership. I'm not going to get into the weeds on that. But if you're a private business owner and you want to use IRA money to invest back into your own business, then you're getting into whether it's not definitely a no, but you're getting into what percentage do you own and what role. But this is more focused on real estate. So when it comes to real estate, disqualified persons can't use the property for personal use, so you can't use it as a primary residence, vacation home, second home, anything like that, and can't do any sweat equity. So you can't do like maintenance. Again, disqualified person. So the account holder, spouse, ancestors, lineal descendants. So if you bought a property in your IRA and you wanted to, let's say you wanted to buy a property from your parents, right? Your parents are whatever, they're downsizing, they want to sell their property, you want to use your IRA to buy it, you can't. Your parents are a disqualified person, okay? So what is a prohibited transaction? It says this is what is written in the Internal Revenue Code: improper use of an IRA or plan by the plan participant or disqualified person, okay? I'm going to give you some examples of what would be a prohibited transaction. Borrowing money from a disqualified person. The IRA can borrow money. There are financial institutions that will lend money to your IRA that you can then turn around and buy a rental property, for example. But the IRA can't borrow from a disqualified person, so you can't lend your own IRA money, okay? Selling property to a disqualified person. Your IRA owns a property, you want to get rid of it, you want to sell it, you can't sell it to yourself or to your parents or to your children, et cetera, et cetera. Using an IRA or plan as security for a loan. So if you've got a property inside your IRA and you want to go to a bank to borrow money, you can't use that property that's owned by an IRA for you personally to borrow the money. Again, as I mentioned earlier, the IRA itself can borrow money. There are financial institutions that will take that, look at that property that's held inside your IRA and lend you money to buy a second property inside your IRA, but they're not lending you the money, they're lending the IRA the money. What you're not allowed to do is go to a bank and say, hey, I have an IRA or a property inside my IRA, I want to borrow $500,000. They can't lend you the money and use the property or the IRA itself as collateral for you personally to borrow money. Buying property for personal use, I think I mentioned that one already, has to be for investment purposes only. You can't stay in a property or use it as a second home or a vacation home, you or any other disqualified person. And then finally, this is where it gets into investing in startup companies, private companies, investing in a company that's owned by a disqualified person. So when you get into the section of the Internal Revenue Code that talks about prohibited transactions and disqualified persons, the investing in a company owned by a disqualified person is not that black and white. You could potentially invest in a company that's owned by yourself or by another disqualified person, depending upon the percentage ownership that you have, depending upon how active you are in running the company. Like if you're a passive owner in a company and you own less than 50%, then your IRA can invest in that same company. If you are running that company or you're involved in managing that company, then you can't own more than 10%. Again, doesn't have anything to do with real estate, but just something I'd mention that it says investing in a company owned by a disqualified person. Yes, wholly owned by a disqualified person, you can't. Partially owned by a disqualified person, you might be able to, okay? So what are the different ways that you can make an investment, specifically real estate, inside your IRA? You can just buy it with cash. Your IRA has $500,000, you buy a property for $400,000, you buy it with cash. Your IRA can partner with other investors, and I'm gonna delve into each of these in a second. Your IRA can borrow money, as I've mentioned, leveraging or debt financing, and then finally, limited liability corporations in which your IRA invests in an LLC, and the LLC invests in the property. If you've ever heard the term checkbook control, or after this ends and you go do some research about self-directed IRA and you come across the term checkbook control, they're talking about the LLC, which again, let's talk about these in detail. So the first one, direct purchase. Your IRA, as I said, has $500,000, buys a property for $400,000, just pays cash. It's the simplest, it's the quickest. You're using the cash in your IRA. You're using the liquid assets in your IRA. So for an example here, let's say an IRA purchases a rental property near Lake Tahoe. We're in the Bay Area, so investing up near Lake Tahoe is something that people do. Title is held in the name of the IRA. It's not you that owns the property, it's the IRA that owns the property. So standard naming convention for an IRA is some version of custodian name for benefit of the account holder's name and account number. So anybody that opens an account with us and uses that to make an investment, whether it's investment in a startup company, whether it's investment in real estate, whether it's investment in whatever, it's a note. The lender on that note, the title holder on that property, the owner on the subscription agreement, the investor for that private company is the Entrust Group, FBO, that individual's name and their account number. FBO stands for benefit of. So rental income, get paid to the Entrust Group, FBO, their name and account number. Any expenses like property taxes, insurance, et cetera, gets paid by the account. The account holder sends us the property tax bill, we pay it from the account, right? So the purchase contract, the closing documents, all of that in the name of the IRA and signed by the custodian. We are the signatory on behalf of the IRA, so they have to submit the contract to us and tell us to sign it. So we get our instructions from our account holder. The IRA buys the property and it all funnels through us, but everything's done at the instruction of our account holder. Read and approved, yeah, that's just something we do. We ask our account holders to write read and approved, but again, we're the signatory on behalf of the contract, so we're the ones who sign all those closing documents. If there's earnest money, it's the IRA buying the property. The earnest money has to be paid by the IRA. As I mentioned earlier, rents and expenses flow into and out of the IRA, not to the individual. And then, again, personal use. Can't stay there on holiday, can't use it as a vacation home, can't use it as a second home, right? Investment purposes only. All right, everybody with me? You guys all awake? Partnering. Your IRA can partner with other investors, including yourself or including a disqualified person, on a new investment. So what I mean by that is, let's say you already own a rental property, and you decide that you want to sell 50% of your rental property, ownership of that rental property to your IRA. You can't. That's a prohibited transaction because you already own the property. But if there's a property out there that you want to buy that's owned by some non-disqualified third party, and you decide, I want to use 50% from my IRA and 50% from my personal savings, that's allowed. Because you're now partnering these two investors together on a new investment. It's a new investment. It's not an investment that's already purchased, right? So again, if you already own a rental property or your parents own a rental property, and you want to use your IRA to invest in that, to buy into that, it's too late. It's already owned by a disqualified person, right? But if it's not owned by a disqualified person, then you can partner your IRA with anybody. You could have multiple partners. You could partner with one other person. You could partner with your spouse's IRA, you could partner with yourself, you could partner with anybody that you want on a new purchase, okay? Ownership is proportionate to the investment percentage of each partner. So what that means is, in the example that I just gave, actually I'm going to show you because we get into this. So here's an example. Husband and wife's IRAs are the partners, permitted at the time of purchase only. So in this, they're going to purchase a rental property near UC Davis, again, Bay Area thing. Each invests 50% of the purchase price. So on title, on the contract and on the closing documents, it's going to be the Entrust Group, FBO, husband's name and account number, as to an undivided interest, 50%. In this example, 50%. The Entrust Group, FBO, wife's name and account number, as to an undivided interest, 50%. So it's structured. The title is going to be held in the name of both IRAs at their percentage ownership. So rent, income, again, rental income, 50% to the one IRA, 50% to the other IRA. Expenses, 50% paid from one IRA, 50% paid from the other IRA. So that's what's called partnering your IRA. It's partnering with a small p. This is not a legal partnership. You're not necessarily setting up, like you hear the term of partnership as a company type. It's not that legal. It's just a term we use in the industry when you're combining more than one, an IRA with somebody else as an investor, yeah. Yeah. Yep. Yeah, so if you didn't hear the question, is there a specific, like, does it have to be a certain percent or can it be anything? It can be any percentages that you want. I have a property in my IRA. I did 10% in my health savings account, 90% in my IRA. So, yeah. Sure. Yeah, you can have more than two partners. You can have as many partners as you want. Now, depending upon how many partners you get involved, you might want to structure it through an LLC, and we'll get into that, as opposed to having, like, let's say 4 partners hold, multiple different percentages of a property itself. It might make more sense to set up an LLC, have the 4 partner into the LLC, and then have the LLC own 100% of the property. Right, and then the rent would get paid directly, instead of the tenant necessarily paying rent to 4 different owners at certain percentages, they would pay the LLC, and then the LLC can disperse out, and you would manage the LLC. I'm kind of getting ahead of myself with the LLC piece, but it would probably be a smarter structure. I mean, again, you can do it whatever way you want. Like, there's no compliant reason that you have to do one versus the other, but it would probably make a lot more sense to do it that way. Okay, and then the last bullet point, daughter cannot rent from the IRAs even at fair market value. So again, a daughter is a disqualified person, right? Lineal descendants. So can't use the property, so if their daughter's going to school at UC Davis, they can't use the property as for their personal use. They also can't go in and do work on the property. Like, let's say they're changing tenants and they ask the daughter to go clean the property for them and they'll pay them. That's not allowed. The daughter's a disqualified person, no sweat equity. Okay? Somebody ask something? What that? Sons, yeah, same. Lineal descendants. So lineal descendants, sons, daughters, granddaughters. Step are not considered lineal descendants unless you adopted them, right? So if you get married and your partner has kids, unless you actually formally adopt them, that stepkid would not be considered a disqualified person. Debt financing, what's called a non-recourse loan. There are financial institutions that will lend the IRA money. There aren't a ton of them. We have a list of 6 on our website that on the Entrust Group website that other Entrust clients have used to have their IRA borrow. It has to be, by rule, it has to be a non-recourse loan. What that means is that the loan is getting made to the IRA, and the only collateral that the lender can use is the property itself. They can't use other collateral that's inside your IRA, okay? They also can't come after you, so you can't use any like personal, you can't use like a personal guarantee, you can't use your personal home as collateral. It can only be property held inside the IRA, okay? Again, there's a fairly limited number of financial institutions that will do this, but they will do this. Now, the bottom bullet point again, and it says no credit check, it's because you're not the borrower, the IRA is the borrower, so what they're going to be looking at is how much you're putting down, what's the loan to value, what's the expected rent, what's the appraised value, but things like your ability to pay the loan back is not applicable because you're not paying the loan back. The IRA is paying the loan back, right? So they're going to look at the IRA's ability to pay the loan back. An IRA doesn't have a credit rating, so there's no credit check. UDFI, does anybody know what that stands for? Unrelated Debt Financed Income Tax. So I'm going to give a real quick explanation of how UDFI would apply and what the IRS is thinking on this is. So let's say you buy property. I'm going to use really simple numbers here. Let's say you buy property for $200,000. You have $100,000 in your IRA. You put that $100,000 up. You borrow the other $100,000. Then let's say at the end of the year, your IRA got income of $10,000, right? Well, the way the IRS looks at that is they say, okay, well, 50% of that money, $100,000 came from the IRA. The other $100,000 came from outside the IRA. It was borrowed money, which means only because 50% of that earnings of that $10,000 came from outside the IRA, then 50% of that earnings is not tax protected. So there are tax tables, there are trust tables and they work the same way income tax does, that they're graduated, in that it's going to say, okay, any income, the 50%, so in this case $5,000, right? So it earned $10,000, 50% came from borrowed money, so 50% or $5,000 is subject to unrelated debt financed income tax. So you go to the tax tables, the trust tables, and say, okay, so up to this dollar amount, it's at 10%, and then at this dollar amount, it's 18%, and overall, we have to pay $1,200 in unrelated debt financed income tax. So after the IRA pays that year, what you actually made was not $10,000, but $8,800. I'm making up numbers. I have no idea what the actual tax would be. But the point being is if this is something you decide you might consider doing and you're calculating your numbers, right? You're trying to figure out what the cash return is going to be, whether it's a good investment, does it make more sense, just keep it in the stock market. And if the IRA is going to borrow money, don't forget about UDFI. Okay? Now, the other thing about UDFI is as the note is being paid back, the UDFI for the following year would be at a different rate. So let's say you're paying the loan back and at the end of the following year, you now have paid it down to where the loan is now at 40% and your IRA owns 60%. And let's say you make the same $10,000 in rental income. Well, now this year, your UDFI is going to be based on $4,000 because you bought the loan down. Does that make sense? Everybody got that? Again, still awake here? Okay, this is the last thing, and then I'm going to be ready to take questions. So, funding options, a single member LLC. So everything that I've been talking about so far, except for the brief explanation where I talked about partnering, assumes that your IRA holds direct title on the property, right? But there is another way that you can purchase a property using your IRA, and with your IRA holding direct title, Entrust as the custodian has checkbook control. We hold the money, you send us the bills when they need to be paid, the rental income gets directly to the IRA, so we're writing any checks that are associated with the investment inside your IRA. If you have to pay any expenses, they have to be paid by the IRA, you submit them to us, maintenance expenses, we pay it from the account. So we have checkbook control. But again, as I mentioned earlier, if you find yourself reading any books or hearing about self-directed IRA and they come through the term checkbook control, this is what it's talking about. So instead of your IRA investing directly in the property, let's say that you decide, well, I don't want to have to send, like people are doing fix and flips or note investors where they're oftentimes writing a lot of checks, want to be able to have immediate access to write those checks themselves. And so the way you can do that is instead of having your IRA hold direct title on the property, you set up an LLC, you name your IRA as the member, right? The Entrust Group, FBO, your name and account number becomes the member, but you as a person can be the manager. So there's a difference between a member-managed LLC and a manager-managed LLC. In this case, it would be a manager-managed LLC, where you can name yourself as the manager. And so instead of the IRA investing directly in the property, you set up an LLC, send us the operating agreement with the IRA as the member, we sign the operating agreement, we send the money to the LLC. Now, you're the manager of the LLC, so you set up the LLC, you set up the bank account, we don't create the LLC for you. Now, we can refer you to people that other Entrust clients have used, but you as the manager are now the signatory on behalf of the LLC. You're the signatory on behalf of the bank account. You've created the bank account. You've named yourself the manager. Now this LLC becomes a pass-through entity that you can use for investment purposes, but you're now writing the check. So instead of the IRA buying the property, the LLC buys the property. But the LLC is owned by your IRA. Right? So it's still IRA money, it's still all the same prohibited transaction rules apply, you still can't use it for personal use. The LLC simply becomes a pass-through, giving you checkbook control over your IRA funds. And as I mentioned earlier, if you're partnering, this can become very advantageous when you're getting into a partnering arrangement if you're going to exceed 2, really. And so that you can have a single entity who is paying the mortgage. If you borrow money, you have a single entity that's receiving the rent. You have a single entity that's paying the expenses. But the money that's coming into the LLC, if you decide that you want to pay out to the investors, it has to go from the LLC then back to your IRA along with other partners. Or if you just do a single member LLC and the IRA is 100%, like you can't take money directly from the LLC for personal use. It has to go from the LLC back to the IRA, then you take a withdrawal from the IRA. Right? So again, checkbook control. That's the biggest thing that you're going to hear associated with single-member LLCs. So as custodians, nobody's going to give you a book of checks. Like there isn't a custodian that says, here, you can have checkbook control. Here's checks for your IRA. Go crazy. Write all the checks you want. We're not allowed to do that. But you can get checkbook control through the LLC. So advantages, checkbook control, immediate access to funds, savings, potential savings on fees. It depends upon the type of transactions you're doing and how many transactions you're doing. It could also cost more money because, as some of you may know, to set up an LLC in a state, you usually have to pay the state some kind of annual fee. Depending upon the state, you might have to hire somebody to help set up the LLC. All those things come with upfront costs. And then some limited liability protection from the claims. I mean, that's obviously a limited liability corporation, but I had a lawyer, I did a presentation before, a lawyer stood up and said, IRA gives you every bit as much liability protection as an LLC does. So it's basically double liability protection, but the big thing that you get from the LLC is the checkbook control. Disadvantages, it can be costly to create depending upon your ability to do it yourself. You're now responsible for maintaining all the records. So all the rental income that comes in, all the bills that get paid, you need to keep good records in the event of an audit. May be subject to state taxes and filings. I don't know about taxes, but there's a good chance that depending upon the state, it might have to file something. Check with your financial or tax advisor. So that's kind of it. To do a self-directed IRA, you just have to open an account with a self-directed custodian. You decide what type of account, traditional IRA, Roth IRA, SEP IRA. Usually you're going to open the same type of account that you're funding it from. So if you have a Roth IRA with Fidelity, then you're going to open a Roth IRA with your self-directed custodian. Then you fund the account. You either transfer, roll over, or make a contribution. If it's going from one IRA to another IRA, it's a transfer. 401k to an IRA or any non-IRA type retirement account, pension plan, it's a rollover. Or you can just make an annual contribution. Again, these are still IRAs. They're subject to all the same contribution rules, distribution rules, tax rules. There's nothing unique about those rules with a self-directed IRA. It's in the service that we provide and the types of investments that you can hold. And then step 3, purchase your asset, which should better say, instruct to the custodian to purchase the asset, because that's what you're doing. You're submitting the paperwork to us and saying, okay, Entrust, here's the property I'm buying, here's the address, here's how much I'm sending, here's the title company information, here's where I want you to send the money. That's some summary stuff. Again, IRAs can invest in virtually not in virtually any kind of real estate. IRAs can invest in virtually anything. And then the different funding options, and then make sure you're doing your own due diligence, again, so whatever you want to invest in, it's your responsibility. Work with a good IRA company. Hopefully you work with a realtor and title company that maybe have some familiarity with self-direct IRAs, but not necessary. Again, titling of the asset, the entrust group, FBO, your name and account number, all custodians, self-directed custodians are going to have some titling that's going to be similar to that. It might not be precise. They might have your account number first, or they might have your name first and then FBO, something like that, but they're all going to have the custodian name, your name, and the account number. And then property management, you're not required to have a property manager, but it is probably a good idea. But certain things you can't do as a property manager, you can't hold the money, right? So like, if your IRA owns the property and it's rental income, either that rental income has to go directly to the IRA, or it can go to a property manager as long as the property manager isn't a disqualified person. So that's actually how I do mine, right? So I'd mentioned the 10%, 90%. It's out of state. I have a property manager. All my rental income goes to the property manager. They hold the money for me. Bills go directly to them. They pay the bills, send me statements, and then once a year or so, I tell them to send a certain amount of money to my HSA and the rest to my IRA, right? But the property manager isn't me, so I can do it that way. If I was going to manage the property myself, I can do things like show the property. I can meet tenants there. If there's work that needs to be done, I decide what contractors I'm going to hire. I can go there and show the contractors the work. I just can't do the physical maintenance, and I can't hold the money. It has to get paid either to a non-disqualified third party or directly to the IRA, usually directly to the IRA. Okay. I mean, you'd want to ask a lawyer that. But, I mean, you don't own the property, right? So they would have to sue the IRA, right? Now,
so then follow-up question to that. Say the balance in the IRA before doing it is 200 grand.
Yep.
100 grand doing it.
Yep.
Is that other 100 grand that is now sitting in cash in the IRA, at risk?
It's certainly possible, but again, those are legal questions. I actually don't know how that would be, how that would work. I don't know of any instances where one of our account holders, like their IRA got sued. That wouldn't come across my desk, so I don't have a case study to give you as an example of here's how it happened. But I mean, speculatively, yeah, I would think that probably that the cash inside your IRA would be potentially available as part of that lawsuit, whereas through an LLC, it might not. But I'm truly not sure, because if your IRA owns the LLC, and they're suing the LLC, they go to who owns the LLC, it's the IRA, they see there's more money. Does it provide that additional protection? Again, I don't know the answer to that. Any other questions? Okay. I'm the one table upstairs that is here with swag and all that stuff. So feel free to come up and get I've got FAQs on investing in real estate. I got an FAQs on doing the LLC. A few things hand out, some mouse pads. So feel free to come up and take whatever you want.
So we do have one more speaker. She's a very interesting person, so I'm ready to hear her story. You should be very interested in her story. But she will be the person closing it out. And after the last speaker, we will do some more networking, and we will probably end up going to an after event that will be between Dovetail Brewery and Beguile Brewery. They're literally on the other side of the street here. So they're a stone throw away, and we can get drinks there and continue with networking and partying if you want to. Say that again? Stone's throw away. You literally can see the building from here. So our last person. But I want to cue up the videos, cue up the video for, oh yeah, you wanted it.
All I do is win, 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 no matter what. Got money on my mind, I can never get enough. And every time I step up in
my anthem. All right. So who am I and what do I do? I get asked this all the time. I am a pretty big character, and I will own that. I think it went dead. Oh, slides are coming on. Hang tight. Hi, guys. You guys look, do you need to stand up and like do the hokey pokey? Do we need to touch our toes, reach up? You guys look like you're dying out there. I always usually go after lunch because I get everybody rolling. So what am I and who am I and what do I do? I have the Matosa Millionaire Method. This is something that I put together after leaving my corporate career. I'll share all about me and my craziness. But there's one thing that I've realized leaving my corporate job that entrepreneurs do not understand, and it's money. How many of you guys know money? Kinda? Oh, you're brave. I got one. Nobody else? You guys weren't trained in money? You didn't get taught budgeting? Financial statements, balance sheets? I just had a client send me a balance sheet. It was his bank statement. I was like, wow, this is not a balance sheet. This is called a bank statement. But what I wanted to teach you guys and come here is basically the basics of what you need to know about money and how to get yourself out of a doom loop and get yourself back into an upcycle. So the three things that I teach people about money is it's the triple M, so the Matosa Millionaire Method, and you guys need to remember minimizing, managing, and multiplying. Those are the only words that you need to understand about money. And everybody tells you the same thing about money. Make more, and you won't have to worry about it. But it's getting a lot harder, especially when you're a W-2 person. So you want to minimize your costs. So if you look at billionaires, let's use Warren Buffett. What does he drive? What is the beater? It's a Toyota Camry. He drives a Toyota Camry to remind himself of where he got and why he got there and how he got there. He could buy any car that he wanted. He makes plenty of money, right? We all agree? Plenty of money. But he does it to remind himself to always stay humble because he didn't start there, but this is what got him there. And so it's one of those things that people rarely, they get a taste of money and they go and buy all this fancy stuff. They buy a watch, they buy a car, they buy a house. And then next thing you know, you're in the rat race of keeping up with the Joneses. And that's where everybody goes from potentially being a millionaire to being destitute. And I say that because I have a girlfriend, she's a lawyer, she's a partner at a law firm, and she's like, yeah, Jacqueline, you should have been a lawyer. You could be making the mad bucks I'm making. Fast forward 6 years, she's like, I should have copied you. I failed. And I'm like, yeah, because you wanted the fancy car, the fancy house, the Louboutins, and all the fancy stuff, right? And that's not what's going to get you where you need to be. So minimize your costs. We're going to dive into this. Managing your assets. What does that mean? How many of you guys have been divorced here? Raise it high and proud. It's not always a bad thing. I'm divorced, happily. How much, if you guys don't mind, how much did you guys pay in your divorce to your exes? 0. Okay. A lot? Half? 50,000? Oh, 150,000. So when I went to my divorce table at 29, I should have paid my ex $550,000. And I paid his legal fees of $8,500. And he was devastated. He thought for 9 out of 11 meetings, he was going to get $550,000 to include 2 homes. And he was stoked. So we're going to talk about what it means to manage your assets. Nobody in America is taught how to manage their assets. If I was a millionaire by 29 and I owed him money and he got nothing, that's managing. That means I'm in business for me, not for anybody else, and you can marry me for my money, which he did, and I found out, and you're still not going to get it. So joke's on you, sucker. You don't need a prenup. It's all a lie. The prenup only protects you for after you're married. So it'll tell your future spouse what they can and cannot have, or you can just take it all away and put it in a different way. And then we're going to talk about multiplying money. So this is where you hear a lot of people talk about compounding money. So the key here is, what's your biggest cost? Do you guys know your biggest cost in a business? Let's hear it. People, wages, and Taxes? Did I hear taxes over there? Okay. What's the third? Health insurance. Most people call Blue Cross, Anthem. They're like, oh, I need health insurance. It's the most expensive thing. What if I told you all of the billionaires have their own insurance plans? They're self-funding. They're self-funding all their property taxes, all their property insurance. They're self-funding all of that and running it through their insurance company. How would that make you feel? That they're not even in the systems that y'all are in. They play in a whole different world. It's a whole different ball. So I want you guys to learn and think about how they do things differently. I could talk for hours on this, but I'm a crazy person and I know crazy people. I've done a show with Kevin Harrington. The guy next to Kevin Harrington is Billionaire Fred. He flips home on Billionaire Row with Vanilla Ice. I was on HGTV. Vanilla Ice is also on HGTV flipping mansions in Florida. I've been on JT Fox's stage now 2 times, and Adam Coffey is also a billionaire doing private equity, spinning off. So these are the people that I hang out with. How did I get here? I have a great story, just like everybody else, because otherwise you can't get on stage, especially big stages. I've been speaking since I was 23 in my career. I moved to America when I was 5. You can see I'm a cute little girl. I was super happy. And then you look at the next one when I moved to America, and I was not happy. I hated America. We went from being a middle-class family in Switzerland where we had health care, child care, everything was paid for. At 6 months, I was going to preschool learning how to speak multiple languages. By the time I was 5, I went into kindergarten and I was bullied because I spoke 6 languages, and they couldn't understand me, but I could understand them, and I was stupid. None of it made sense. I wanted to get on the next flight back home, and I wanted to go back to Switzerland, and I was not allowed to. We lived on my mom's student teacher salary of $24,000 a year in a town called Los Gatos. If any of you guys know where Los Gatos is, it's in the middle of Silicon Valley, and it's pretty much now the average median house price is $2.5 million. So you can tell that that house still exists to this day. I drive by every time I go home, and I look at it, and I think about how far my family and I have come, because it was meager beginnings. My mom rode a bike. She didn't drive because we didn't have money. And then at the age of 10, overnight, we were multimillionaires. $2 million was wired into our account. My parents were fighting over how big of a house and what amenities the house was going to have while I was stepping on carpet with nails poking my feet every day. None of it made sense. I'm going to do a comedy show. Eventually, it's going to be called I Don't Understand, because that's my whole life. I didn't understand any of it. I'm like, guys, any house is better than this house. This is a piece of crap. But, that's how it works. And then at 15, my mom told me, go get a job. And you can't have a job at Jamba Juice because you're never going to need a man because your dad screwed us, and we're out of here. My parents were bankrupt. They went through $8 million in 5 years. And I didn't understand because my neighbor next door, who was a CFO of Cisco Systems, was bringing a new Ferrari home every 6 months. What happened? None of it made sense. I don't understand. So my whole childhood was very confusing. How is someone who speaks more languages than one stupid? How did we get here to broke, and how did we go to millions and broke again? I had to pay for my own stuff. I pole vaulted. I was in the Junior Olympics my first season at 16. I never pole vaulted. In 2 months, I was in the Junior Olympics. My mom told me, I'm not paying for it. Go figure it out. You're not going to need a man. I'm not going to help you. And I said, cool. You know what, Mom? Awesome. I'm not going to need you either by the time I'm 17. By 16, I made $40,000, the average wage of an American in the United States. And I was hell-bent to make a name for myself and not rely on my parents. It was the worst thing they could have done, because when I was 16, I bought my own car. And I was off to the races, and my mom would try to tell me what to do, and I said, I don't need you. I'll go live in someone else's house, because that's all you give me is a roof over my head. I was playing with fire, and I thought I was on top of the world. So at 18, I went from working at Alon Pinnell, one of the top real estate firms. I got my license as a real estate agent, and I went to school. I wanted to be a doctor, and I got to school after my mom told me, we have a trust fund for your college. You don't have to worry about it. My first month there, my mom called me and said, I don't know where the money went. And I said, Mom, it's in an irrevocable trust. I'm 18. I have to sign off. Beneficiaries have to sign on any changes. Where'd the money go? She goes, I don't even understand what you're talking about. I said, yeah, because you're not educated, Mom, and you don't understand money. And I was already going to school for money because I wasn't going to be like her. She was right. She made a daughter who wasn't going to need a man, and she made a daughter who was going to stand on her own 2 feet. So I got an accounting degree instead of being a doctor, and I worked my way into one of the top firms in the world, Ernst & Young. So top 2 firms in the world, depending on which area. I did international taxes, which was mergers, acquisitions, new market entries. And I say all of this to tell you guys, basically, I learned and played with billionaires by the time I was 21. I got my CPA degree or license in 3 months. 32% of people pass their CPA license on the first try. I passed all 5 on the first try. I was hell-bent and determined that I was gonna figure this out and I was gonna go to the top. I bought my first place when I was 22 and was a part-time real estate investor while I was a CPA traveling different continent every other week. No one was gonna tell me I couldn't do something. Everyone told me don't buy a house at 22. You know what, I bought it. Market crashed. I got my first life lesson, 2007. And you know what? I also knew money. Did I sell? I leased it out. I rode the market out, and I doubled down in the downturn and bought a duplex. From there, in 2016, I sold both of those properties and bought a building in San Francisco worth $2.3 million. Why? Because I understood markets, I understood how the economy works, and I understood that you never lose the money until you realize it. I made money on all of my properties. I'd quadrupled my money on my second buy. And I say all this because by the time I was there, I was moving back home to the Bay Area, and I was the head of international tax at SunPower at the age of 28. I managed $10 billion in revenue, 150 subsidiaries around the world, 26 employees, and I did 100 mergers and acquisitions, IPOs, new market entries, restructuring, and I managed 26 tax rulings. Nobody should have been in that role at the age of 28, but I made sure that I was the most technical and I was the best. You hear all these people on stage, they're talking about data, 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 data. If you don't understand the numbers, you don't have a business, you're gambling. And that's what people in America don't know. They put their money in stocks. Oh, I'm trading stocks. Do you understand puts, calls? Do you understand options? Do you understand margin trading? Do you understand all of this stuff that goes into day trading? No, you're gambling. You're just getting lucky on the high and the low and waiting until it comes back up. That's not how we manage billionaires' money. If I managed a billionaire's money gambling, I wouldn't be where I'm at today. So, at 36, I left my CPA career. I worked at Square, I worked at Gap, I worked at Gilead, and now I work for Proxy Financial, where I hung my CPA license, and I head their private equity division, and I'm expanding their capital arm. I also went on HGTV in between and took a year off and had some fun. I got to be on Battle on the Beach, and we flipped a home. Flipping is how I made my money. I never flipped a home unless I made 6 figures. My average flip was $175,000. My best flip was $450,000. So I was making more in my real estate job as a CPA than I was in my CPA career. It's pretty devastating when I was doing that part-time. So I realized, okay, you know what? It's time for me to go bet on myself, and it's time for me to go big. So I knew family offices, I knew private equity firms, I knew hedge funds. I was like, I got this. I just got to find my way and figure it out. Took a year off, filmed on HGTV, cleaned up my life, did one luxury flip, kind of just chilled in Las Vegas in the desert and figured out my life and how I wanted to move forward. I joined Proxy in October 2012, and now I'm on stages making people money and having fun. I love my money gun. I didn't bring my money gun today, guys. But what I say is I come with a lot of experience, as you guys can see. A woman has to do 4 times the job in a corporate environment to become a director of any position. I was the head of a department, and the CFO was asking me what that transaction was and what it meant because he didn't know. So I have a lot of experience on the front end. I didn't do tax returns. I did one person's tax return, and I realized this isn't it. I wanted to be a thinker, and I wanted to understand money. So I learned how to manage legal structures. I was telling the lawyers how to build their legal structures because I had to manage the tax arm throughout the whole world. And we'd do transactions where things were made in the Philippines, sold in Switzerland, wholesaled through Switzerland into our distribution centers. And all of these have a tax. Every line of every revenue generation has a tax. And if you don't understand that tax, you're going to be in big trouble. How many of you guys are flippers or run Airbnb businesses? How many of you guys pay sales tax when you buy cost of goods? all of you. You would be pretty upset if I told you you could actually file a contractor's exemption and never have to pay that if you ran it through the right legal structure and you could get all that money back, because it's a B2B transaction. And most people don't teach you. Your CPAs don't know these things because they're not planners. They're people who just do data entry. So this is the power of a legal structure. Oops, I went back. I got to go forward. So how do people structure their lives when they're self-employed? This is how the mega people do it. You've got the holding company at the top, underneath the self-employed person. The self-employed person took their 401k, AKA me. I built a rollover business startup self-directed. My self-directed, funded, we just heard those. The way I do it is different. I funded a brand new C corporation. I bought stock in my own company, right? You can buy stock in a 401k. So you can buy stock in a brand new company and get rolling. From there, I went and bought a bunch of real estate, and I had a lot of fun decorating and flipping it and making it look pretty and not paying sales tax. Then when I decided, hey, this one made me $450,000, but I don't want to pay tax, I put it in a deferred sales trust. From there, how many of you guys have done 1031s? One? Nobody else has 1031'd anything? Two? So a 1031 requires you to identify the property in, 45 days, and you have 180 days to close, right? It's a pain in the butt, especially in a boom market. You can't get a property to close in 45 days without a million offers. That means you'd have to put and identify every single home on the market and hope and beg that you're going to get a property. In a downturn, you're being forced to buy a property that you know is inevitably going to go down. Well, guess what? Billionaires don't do that. They don't play that game. They buy low, sell high. Everything they do, they buy low, sell high. So if you're forced into a 45-day schedule, it does not work. They use deferred sales trusts. From there, they go and separate all of their tax-free states from their taxable states on the income tax side. Why? Because then the taxable states can't say, hey, you owe me money on that tax-free state, AKA California, where I came from. You separate everything, your property and state, and then say you created this whole thing before you got married. You own that stock. You put it in a premarital trust, revocable, that turns irrevocable, or you can have your own irrevocable, your choice. And then guess what? When you go to get divorced, they're like, I want half your properties, just like my ex. And I smiled. I said, sure, you can want whatever you want, honey. Until 2 sessions when we go to finalize the property. And I put the claims against the community with my separate property trust, and he got nothing. And he's a CPA, you guys. CPAs don't know these things. We're not all the same. We are not all created equal. We don't all have my experience negotiating with governments, being in front of the Treasury Department, the IRS, when new law comes out. So this is how, if you're self-employed, you should structure your life. Why? How many of you guys have S-Corps? 3. What are you guys all? LLCs? Pure LLCs? Okay. And it's going straight into your tax return, 1040s? Going straight in? Okay. We'll talk about that later. I'm going to parking lot that. So when I was employed with my W-2 job, my effective tax rate was 2.5%, federal and state, and I lived in California. And everybody in my department was like, what the hell are you doing? And I said, I own real estate. My real estate and my businesses, I forced into losses through my tax planning. And now those losses are active, and I get to deduct them into my wage income. And now all of what I paid in payroll, I get back on my tax return, and I get to buy another property. Sounds pretty fun, right? Everybody else had to pay when they did it because they had bonuses and this and that, and California doesn't withhold for bonuses. You put your house in a trust if you are premarital. You put everything, you guys are noticing a theme, right? Legal entities and trusts are your life. So what did my experience teach me? It taught me that irrevocables and C Corps are life. Your C Corp protects you from legal liability better than an LLC. An LLC is good. It's not bad, but a C Corp gives you a double layer. So if they're going to sue something, they're going to sue the C Corp. But I also learned that the best tax structures are different whether you're employed or self-employed. How many billionaires are employed? Do you guys know? Guess. Somebody guess. How many of them are employed? Just put a number out there. 0? What's the other numbers? All of them. Why are all of them So they pay themselves a W-2. Do you know why? No, so you can qualify for loans on real estate without having to go through the minutia of proving your deposits, your net. Why? Because their corporations don't pay taxes. They don't make money, guys. So you have to learn how to play the game and game the game. And nobody teaches this. You don't even learn this as a CPA unless you are doing the tax planning for them. So I manage legal entity structures. I had lawyers, corporate lawyers, coming to me and being like, I don't understand what you're doing. Why are you doing this? And then I'd explain it to them, and it was always an argument with them because they wanted this for legal liability protection, but the risk was low. But my tax bill was high. So then we'd go to the CFO and the CEO, and we'd say, what do you want to do? And they'd be like, we're following Jacqueline. I'm not footing that bill. That risk is not big enough for me to worry about. Put it in a double-tier structure, and off we go to the races. So we'd put it in an LLC and move on. So, oops, I'm going backwards again. Compounding money. How many of you guys have heard of compounding money? The room. You guys all should be raising your hand. Somebody's talked about it on some podcast, something, somewhere. What would I tell you? How would you feel if I told you you can compound your debt? You guys are all staring at me like I'm crazy. So, how many of you guys know the rule of 72? This is like financial 101. Okay, so if you want to know how long it's going to take to double your money, you take 72, divide it by the interest rate, and that's how long it's going to double your money. So if it's 1%, which your bank accounts aren't even making 1% right now, because the government has conditioned you to not expect it. So you wouldn't be able to double your money. It would take longer than 72 years if you're at 0.5%. It would take you 144 years to double your money in a bank account. So we don't like bank accounts, but we like to leverage our money, right? Leverage is how we get homes. It's how we do real estate. And we also like to pay them off. I like to pay my debt off faster. So how many of you guys pay your mortgages biweekly? Nobody? Okay. How many of you guys have ever made an extra payment to principal on your mortgage? Okay, we got a few. Was it your primary or rental? Primary? Primary? Rental? I can't hear you. Mike? Primary? Okay. So you pay down your primary. Why do you pay down your primary? Because you don't want to pay debt, right? So if you look very closely on the schedule, it's kind of small, but I did some math because I like math, because numbers don't lie. If you have a $250,000 loan at 3.5% interest, I use this example because this is my example from my house I bought in 2011. Your payment's $1,100. You are going to pay $154,000 in interest to carry for 30 years. So you almost 2/3 of the house price goes to interest over the time of 30 years. So if you pay bi-weekly, so that's 26 payments every other week, now you've cut off $22,000 in your interest, and you saved yourself 3.8 years. Sounds pretty good, right? You're paying less. If you do monthly with 2 additional principal payments a year, you now have, that's only $187 a month, you guys. I did the math. You now save $38,000, and you take 6 years, almost 7, 6.7, 6 2/3 years off of your mortgage. If you keep and combine both of those, you do biweekly with 2 additional payments, you can take 9.35 years off your mortgage. That's a decade. More importantly, you save $50,000. You took 1/3 of the cost that you would have paid to a bank, and you put it back in your pocket as an investor. So where people go wrong is they're so hyper-focused on getting an ROI on the top line, they're not looking at, there's 2 ways to do NOI, right? You can increase your revenue or decrease your expenses. Nobody focuses on the expenses and ratchets them back because that's not a cool thing in America. What would if I told you I paid off my short-term rental when I was 2011? I paid it off in 2016 or 15. Can't even do math anymore. In 4 years. What did I do? I made $4,000 a month in profit. How many of you guys have a couple properties that are making $3,000, $4,000 a month? Hopefully a few of you guys in this room. Or you're not buying right. I took $2,000 So $1,100. So my payment was $518. I took an extra $1,100 and put it down on my mortgage. The mortgage disappeared in 4 years. I was playing games, guys. I thought I was onto something at 27 when I bought that property. I was like, how come nobody talks about this? Like, I paid off my student loan debt because I prepaid it, and Fannie Mae and Freddie Mac don't allow you to charge interest on something that's prepaid, so I didn't pay any interest. So what happens if I re-amortize my loans on a mortgage? All your interest is paid, the majority of your interest is paid in the first 10 years. So if you stop that interest, I saved myself $136,000 over 30 years. Guess what I did, guys? I played a game. I said, you know what? I'm going to take a loan and refinance my own properties and take all that money back out into my own new LLC like rich people do. Let's see if this works. Called up my lawyer, and I said, hey, I want to put a lien on my own property, and I'm going to refinance this out to 75% loan to cost on a rental property, following lending laws. Everybody else was doing it. I want to cash refi out. I turned around and went and bought 5 properties with that amount of money. Now I went from 1 property paid off in 4 years to 6 properties, all cash flowing me $3,000, $4,000 because I bought right and I was patient. Took me a little bit of time, but I did it. This is how you compound your money and you get yourself out. Other people paid that $1,100, guys. I just pretended like I never made any money, and I just put it down on my bills and kept paying it down and paying it down. So it was a game to me. Money has always been a game to me. How do I earn more and how do I make more? Because I'm curious. It's not because I'm greedy. It's not because I cared. I was just like, I wonder if this works. Let me give it a try, right? I had a hypothesis like a scientist, and I put it to work. So what did I learn about compounding money? Really rich people, when they compound their money, they invest in real estate. Why? Because it tracks inflation and cost of living. So when I was buying in the out, I came out, 2011, I bought a duplex. I rode that thing out. In 2015, bought 5 more houses, and I had the original duplex. And then it just kept going up and up and up to the point where I sold off some homes and bought a building in San Francisco. With only 2 properties, guys. With only 2 properties out of my 6, bought me a building in San Francisco. So the other thing I learned was, well, buildings make more money because they're bigger. They make more money. Why? Can you guys guess? There's a larger barrier to enter. It costs more capital. How many people have $500,000 to put as a down payment? Not very many. So now your returns are higher. 85% of commercial real estate is partnerships. So when you look at those big buildings, you're like, wow, it must be nice to be that rich guy. It's not one rich guy. It's a couple. And if it is one guy, God bless him, because that does exist. I've met them. But the other thing I learned about commercial real estate is I can do my day job and not have to manage contractors and buying supplies and doing this and doing that. I can just put the money in as an LP, and it's making me money while I'm working. I officially got to be a real estate princess when I learned about commercial real estate. And I stopped churning my flip portfolio because I was already doing luxury flips at that point, my building in San Francisco, and I was like, this is exhausting. And I make good money, but it's exhausting because I work a day job, which I'm already working 20 hours a day on 2 different continents every other week. So let's not do that. So commercial real estate is really how people compound their money with the least amount of effort. They find a great syndication team. I had an accounting firm that had a fund, and they did all the real estate, and I was lucky and privileged enough to be able to qualify as an accredited investor and buy in. So I was off to the races. Now I was making the big-time money, and that's where you compound. The other thing I learned is that they invest differently. So a lot of people buy life insurance for death, and they pay term. Term is trash. It's an expense. Rich people don't have term. They buy life insurance like Walt Disney so that they can turn around and take the money out and go fund their business. Because then they don't have a bank loan, they loaned money to themselves. They also use retirement accounts where they can put unlimited amount of money. How many of you guys hear that 401ks are limited, right? Not to rich people. It's called profit sharing. You can put an unlimited amount of money in retirement account income, and then you can do a rollover business startup and start your own new business again and again and again and again. So you take money from Uncle Sam, you put it somewhere else, and then you roll it into something else, and now it's back in your pocket, and you're off to the races with a new business. It's pretty disturbing, right? Rich people have cracked the code on the tax code. They don't care. They don't care. There's no rules for them. They paid me a lot of money to go find them ways around all of this. And they get the benefit of it that nobody knows and nobody learns. The other thing is they manage their leverage to their advantage. So they leverage, they pay off the leverage with their profits. They turn around and get more leverage on their own dime. And now guess what? They're private money lenders to themselves. Just a different LLC. How would you guys feel if I told you I work with a family office who has unlimited debt? One fund has $40 billion, and he has an equity fund. And he's like, I just do my own deals. And sometimes I give my homie a hookup, and he can come in. Like, it's a different world, you guys. Once you're in the private money lending world, it is a different world. That is the holy grail. That is where you make all the money for the least amount of work. Because if somebody messes up, you take over the building, and now you got it at a discount. So, minimize your taxes. So this is where we talk about recovering. How would you guys feel with those of you who have S-Corps, LLCs that go into your 1040s, CPA in the back, who's looking at me in my lessons? 85% of individuals pay the Treasury Department's budget. C corporations pay 9.9%. This is from the IRS website. You guys can go look at it. This data is as of April, I think 2023 maybe. This might be an old slide. But the point of the matter is you guys are paying the bills. This is why the middle class is gone. This is why I left my career to educate people so y'all can start playing the same games they're playing because it's not hard and it's not expensive. My rollover business startup, guess how much it cost me? $4,995 to pull $550,000 out of my retirement account. That's it. That's the best ROI. And then you have Grant Cardone on social media saying, oh, liquidate your 401k and give me your money. Yeah, pay 50% taxes, guys. Sounds like a good idea, guys. He's a drug addict turned real estate investor. Why would you take financial advice from him? What is his license? Nothing. So why do we listen to him? I don't fucking know because I don't get it. This is just the world I don't live in. If you don't show me your resume like I showed you, and it doesn't prove to me you know what the hell you're doing, I don't care. You could tell me about the sky is purple, and I'd be like, great, it's purple. And I'd walk away and be like, that guy's an idiot. So when you know C corporations are paying 9.9% of the Treasury Department's taxes, let's look at this differently, you guys. 2/3 of the U.S. GDP, which is $25 trillion, is C corporations. 9.9%, guys. That was me. I did that. Did a hell of a job, didn't I? My peoples on the international tax side, we crushed it. We are the biggest ROI. They'd give me $200,000, I'd get them $6 billion back. Because I understand numbers and math. And if your tax bill is one of your top 3 bills, you got to get your tax bills down. It's not optional. And if your CPA isn't doing it, call me. I'll do it for you. If we are netting $1.8 trillion in profits after all the tax planning and everything with C corporations, and we're employing 29.7% of most of them in C corporation public companies. These are the SEC companies, guys. You guys have not had a pay raise since 2006. How would you feel about that if I told you that? Because that's a fact. Cost of living, cost of housing, cost of gas, cost of everything has completely crushed your W-2 jobs. I know that. That's why I had my side hustle. I knew better than to trust a corporation. He who has the most options always wins. So you guys need to wake up and start playing the game. Don't hate the player, hate the game. and get in it sooner than later, because time value of money, that's another thing we learned in accounting. $1 today is worth more than $1 tomorrow. So the dollar you save today is going to give you more tomorrow if you have it working for you. So, lesson learned, Treasury only collects 10%. So let's talk about real estate professional status. How many of you guys have heard about this? Do I need to go over this, rules? Anybody want me to go over this? We can summarize it. So the IRS characterizes all income as active or passive. You either are actively making that money, W-2, or you're passively getting money, rental income, we'll use for example. The IRS has gone through and characterized all of the trades for real estate professional status. You have to have a certain amount of rules met, material participation, you got to do a certain number of hours. There's like 3 buckets of hours now, guys. I have a whole decision tree I've made that's 2 pages long on a legal page of a PowerPoint to get to a conclusion. Oh, and by the way, your spouse also has to be doing real estate or you disqualify. So this is not a fun law to be a part of if you're not both doing the same thing in real estate, because you'll never qualify, and that's the first thing your CPA will not tell you. But they'll give you the deductions, and then when you get audited, you're going to owe a bill. It sucks. But when I was asked to come and speak on this stage, I said, of course, because Airbnbs are one of the best ways, because there's an exception. So, why is there an exception for short-term rentals? Most people and most CPAs cannot explain to you that. It's because they characterize anything where the average stay is less than 7 days is considered a hotel. Hotel. Hotel is a business. It's not rental income. So they've accepted this whole thing out, and we can go through the Treasury regulations if you want, and I could bore you with my tax speak. Or I can just basically tell you that as long as you do everything for your short-term rentals, you will get active participation. There's a couple of others. It's a little bit harder. There's hour tests and this and that. I always tell people, if you get a short-term rental, do your own decor, do your own furnishings, do it on a platform, and you'll be accepted out of this, and you'll never have to worry about it. But the benefit of that is what's called cost segregation. Cost segregation is the 4th tax depreciation that only commercial real estate is privy to. Single family is not. But this is an exception where you can take a lot of the property that's inside, and instead of amortizing it over 39 and a half years, you now can do it over 5 or 15 years. So you get to accelerate the depreciation, which means you get more expenses up front, less on the back end. So you're allocating for the time value of money. $1 today is worth more than $1 tomorrow. So this is why short-term rentals, in my opinion, and why I'm here on this stage, I think are great. You guys get an exception. As long as you manage them, you do not have a co-host. Sorry. Had to say it. But it's not that difficult. I've had short-term rentals my whole career as a CPA. I didn't do long-term rentals because I needed to make money, because it's time, value of money. I needed to get out of my corporate job. My corporate job was just a means to an end. So this is something that's really big and important for you guys. And if you're paying taxes and you're not deducting everything, and you look at your tax depreciation schedule and your CPA has you in 27 and a half, fire them. Fire them. They're crap. They're not educated. They don't know. They don't know anything. So, how do the wealthy save on taxes? Since this is real estate, I've been hyper-focused on real estate. The tax code is very favorable. I did a whole podcast on my first high net worth individual tax return and how the board of directors guy made $30 million and paid $1,002 in taxes. And I went into my senior manager's office like, oh man, I'm an idiot. I don't know what I did wrong. He's gonna yell at me. And I was like, either I did something really wrong or you need to explain something to me, because this doesn't make any sense. He said, well, what's the total tax due? I said $1,002. And he was like, nope, that's right. Good job. You passed the test. And I was like, I passed the test. I don't want to do tax returns. Definitely not for individuals. I just want to learn for me. And that was the day I learned about cost segregation and the tax code, and how you can wipe out all of your taxes leveraging cost segregation. My client had bought buildings for $5.4 million, turned around, fixed them up, sold them the same year, and he got $5.3 million in tax deductions that wiped out all his gains. I was like, well, hell, I got to learn something. And I was off onto something. I knew I was onto something, and I knew I'd learned something that my parents didn't know. The other thing I learned is with legal structuring. C corporations have 27 more tax deductions than any other structure. How many of you guys have heard about a captive insurance company? One. I have a captive insurance company. I insure myself in my company. Why? Because I'm the only employee. I don't have employees. I don't like employees. I have a lot of contractors. I have a de facto who will take over a number 2 if I die, but I don't have employees. But I can insure myself because if I die, my whole business portfolio and my hundreds of millions of dollars in real estate are at risk. So guess what? I have a captive company. I also have a massive life insurance policy to pay off all that debt because my partners are going to love me. And my family's going to love me more because they're going to get more cash flow. So my legacy that I'm building, everyone talks about generational wealth and legacy and tax planning. My life insurance plans, because they're business, my captive insurance plans, because they're business, are insurance that's tax deductible. And I get to borrow against them. I even borrowed against my captive insurance company at 0.5%, guys. Who can ever get a loan at 0.5%? It was great. When I got that rate back in 2020, I was like, dang, this is legit, it works. I knew it worked. My clients all do it. This is what the corporations do. This is why they're not paying taxes. The coach for Michigan, Harbaugh, was given $4.5 million salary. Who knows how he was paid out and how it was structured? Any of you guys know? He said, give me $1 million up front and buy me a life insurance policy. Why? It was tax deductible to Michigan. When he died, Michigan was going to get reimbursed for their premium payments, and his family was going to get $65 million on the back end if he lived to be 73. So his compensation was not $4.5 million. It was $68 million. And this is what rich people do. This is how they structure their lives. And as long as they don't touch the money and they keep the loans and pay them back, life carries on and everything's great. And they don't borrow against their cash value. Everybody's like, oh, take the cash out. No, you leave the cash in and you put a lien on it and you get a third-party loan. All of these things are structured in a way where you can, with your legal structure, rev up your tax deductions in deductible things that earn you money. My captive insurance is making me 8% in a cash or cash equivalent account where there's no risk. But nobody talks about these things. We talked about deferred sales trusts, how you can defer taxes for 5 years, and until then, you don't have to make a payment, or you can reinvest it all within 5 years into any investment and never pay the taxes. Well, guess what? Any investment could be a T-bill. That's an investment, guys. So do you see the game that rich people play? This is what the wealthy do. It's a game. They've mastered the game. They mastered the tax code. And so it's really important for you guys to learn to leverage profit sharing, retirement accounts, life insurance, leverage your legal structures, and leverage your real estate. So if you guys want to work together, I've got all kinds of businesses. I've got an investing arm. I've got a wealth management arm. I've got my university. I've got my events. I do CPA and tax planning. And then I'll refer you off to my team that will do all the work because I don't want to work anymore. I just want to talk on stage. My next event is October 18th to the 20th. We're doing it in Las Vegas again. We kick off our event with a Fund That Deal. So anybody who has deals, we can fund anything from $75,000 to $2 billion. It's always fun to get people to pitch and learn how to get investor money because capital raising is one of the most important things you guys will ever learn. And then I teach everything and anything when money, taxes, legal structuring, real estate in my university. You can learn anything from wholesaling, flipping, creative finance, from some amazing people. It's not just me. I'm just the face of it. So this is what I have to say. Do you guys have any questions? Yes. Great presentation. Pretty sad, huh? Sorry, the lights are like glaring in your face. I can't see your face. Does your 30% cash on cash get you 5 homes over the next 5 years? Okay. I am a quality, not a quantity person. This is why I'm in commercial real estate, because I want to be a princess, a self-made princess. So you have to have enough quantity to get to that level, right? It's a high barrier to enter, and you have to have a certain amount of revenue, a certain amount of assets in order to qualify in. So I knew if I built my portfolio faster, then I knew I could turn around because I had a job that was paying my bills. I didn't ever touch any of my real estate money. I just reinvested it for 10 years. And that's how I was able to get to $2.5 million in net worth by the time I was 32. And at 29, when I valued it, I was only 1.1 mil because I was turning my money. Mm-hmm. Mm-hmm. Yep. That business meets the real estate, active real estate professional exception. Yes. Yes. If you had a passive long-term rental, that would be subject to passive activity losses. Mm-hmm. Yeah, you'd have to meet the hours. So then it's 750, 500. There's all kinds of different tests. Yeah. It's hard as a wage earner. It's really hard. That's why all of mine were Airbnbs. Yeah. So every month I paid almost $1,640. This was my exact payment I made to the bank. Yeah. So I paid the $518, which was the biweekly payment from the slide before. If you look at option number 1, biweekly, your payment's $561. So I paid I didn't link that right, sorry. Should be $561. So the $561 is your monthly payment on a biweekly. So always take a 30-year fixed, because if there's a bad year in business, you can always go back and go to the lower payment, but it's a lot harder to bump up. So always, you can prepay as long as you tell the bank this goes to principal, or you put an auto flag that says automatically put it. They will hate you. They will tell you they don't want to do it. They will fight you because they have to manually re-amortize your loan every payment, and that's a manual transaction, and they like to just automate it with a machine. So they'll fight you on it, but basically I made that 561. That should say 561, but it says 518. And then I made double that payment on top of it. So I made 3 payments. So I made 2 extra to principal and 1 to mortgage every month, every 2 weeks, biweekly. Yes, biweekly. Mm-hmm. Yep. And then I went to the bank and said, put this to principal. Mm-hmm. Nope. I made 1 lump sum, and I told them anything that's over goes straight to principal. It's not to go to interest. You have to tell them, by the way. They'll put it to interest. They're gangsters. Institutional banks are gangsters. They hate me. My banker's like, again? I'm like, again. Keep going. But remember, I was making $4,000 profit, net profit, after all the bills were paid. that was, and then so I took 1,100 of that and paid additional. So I had 4 years. I took a loan out. So I called the title company and said, I'm going to put a lien on this with a new LLC. And I became my own bank. I was copying what my clients were doing. I was testing it. I was like, does this work? So I told my attorney, draft up a loan doc and refinance. I'm gonna be the lien holder over here, and I'm gonna take the money out, cash refi out. I did a 75% cash refi out of my paid off property, which was perfectly acceptable at the time. 75% on an investment property. You would have had to put 25% down to buy one. And then I took that 75% and I went and bought 5 more homes. Yeah, I went to the auction. Yeah. Who's getting the interest on a HELOC? Somebody else, not you. I was paying myself. Upcycle, not doom loop. Anytime you have leakage going out to another person, you're losing money. Yeah, third-party interest rate. Yeah. So I did all of this in my last career. I was responsible for all related party transactions, and I had to calculate what a third-party arm's length. So I knew what the banking terms were: LIBOR +1, Wall Street Journal +1, Prime +1, whatever you wanted to pick. AFR is the rate with the interest rate from the IRS. So you just pick what schedule. But I made sure I had a real estate attorney look at it because I was paranoid. I was like, I don't know about this. I was like, my clients do it all the time. I don't know about this. And it worked. Title took the loan, gave me the money in a bank account, and I was like, wow, that was crazy. It was a hell of a ride. All the things my mom doesn't know I do. Any other questions? So it pays to have a side hustle and to not touch your money for 10 years so you can quit your job. I told my boss to fire me. He fired me, and it was great. We moved on. I went on TV and had fun. All right, guys. Well, I'll leave it there.
Okay. Thank you, everyone. First day. No, I don't need it. Now this is the end. Like I said, her story is very interesting. A lot of tidbits of information. Just putting on a loan on your own property at your own bank. Something I never thought about. But now you've got the wheels turning for sure. But if everyone talks about paying off their home and they can't get any money on it. They need to get a loan on it. They just didn't realize they could be the person that do the loan on it myself. That's a very interesting way of going. And now that you got the wheel turning, I might try to figure out how to do that myself. But yes, that's the end of day one. We still have another packed day of more speakers tomorrow. As of now, we will go into like more of a networking scenario for the next hour or so, and then we can leave the venue, and whoever wants to go over to the Beguile Brewing or Dovetail, we can go over there, and probably around 5:45. And like I said, it's probably a 5-6 minute walk away, so it's not too far. But thank you everyone for coming. I hope you enjoy the rest of the day. And tomorrow it's at 9. So tomorrow is 9, truly at 9. All of our issues with AV stuff and getting the video up and running should be dealt with this time. So we should be pretty good. Thank you.